For the next 30 minutes or so is about the tax and benefit system, but from a slightly different perspective than maybe we usually think about it, and maybe slightly fuller perspective. So I work in the direct tax and welfare sector, or that's what we here at IFS. I'm changing name at the moment, can't remember what the new name is, and well, essentially, it does what it says in the tin. We look at the tax and benefit system and its effects on things like labour supply, its effects on the income distribution, on poverty, on inequality. So quite a big area. And one of the projects that we've been working on recently is trying to extend looking at that from kind of the usual way, which I'll come to in a sec, to kind of a lifetime approach. And kind of the reason for that is that we're used to kind of talking about there being kind of working or non-working families. Kind of we think of these benefit recipients and taxpayers, and some people kind of try to think of these as almost static, unchanging groups. But in fact, there's a lot of mobility over life. There's, mightn't be as much as people would like, but there is quite a lot of changes. People's earning, people move in and out of employment, people move around the income distribution quite a lot. And if you're just to take the kind of a snapshot perspective, which is just to say take the population as it is today, you kind of miss out a lot of features, and you can get quite a different perspective on what the tax and benefit system does and what reforms to the tax and benefit system do than you do if you just look at the population today. So leaving that aside for a second, what we normally do, I'm going to give you some examples of some of the stuff that's normally done. What this graph shows is net transfers, so that is benefits minus taxes, and I'm going to show you across the income distribution. You can see that this is per week, so it's about, on average, the tax and benefit system takes in about £100 a week from people. That was in 2013-14, and it does that obviously to fund public services or to pay down, say, debt in times when the government's running a surplus. But that differs quite significantly across the income distribution for the reason that a key aim of the tax and benefit system is transfers, and to transfers usually from the poor to rich, from the rich to the poor even. And so what we can do to look at that is to divide the population, order the population from left to right, from poorest to richest, and then divide them into 10 equally sized groups, and we count for family size in that. And then so we have these 10 income deciles, so the poorest on the left, richest on the right, and we can look at what net transfers look like, so benefits minus taxes across that distribution. And we can see the tax and benefit system indeed does do quite a lot of redistribution, that on average the richest 10% of the population contribute £700 per week, and the poorest, what's that, about £100 for the second poorest decile. The reason we get this pattern is because the UK has a system, quite a substantial system of in-work benefits. So you get kind of you get benefits still when you're on low income in work, and that's why it goes up a little bit at the bottom. That's why it's not kind of just a straight downward line. And so that's that's one of the aims of the tax amendment system, and it seems to do quite a lot of that. And an effect of this is that it significantly reduces income inequality. So what this graph shows is the Gini Coefficient for gross income before taxes and benefits, and the Gini Coefficient runs from 0 to 1. So before tax and benefits, inequality in the UK is about something like 0.5. It depends on what data set you're looking at, and this isn't necessarily the best one to look at, but I'm using it because I can do a handy comparison for something later on. And so that's before the tax amendment system. After the tax amendment system, once you account for that, inequality falls substantially. It falls to around 0.35 or so, from up around 0.5. So there's a big difference there that the tax amendment system does. The redistribution that it does has a big effect on inequality. But as I've just said, that kind of ignores the fact that people's lives change from year to year. What this is doing is just taking the population today. It's from, say, a household survey. We send out, we manage to get the survey perfectly representative, and we send out forms to each household. They fill them in perfectly. They reply to every question, which they never actually do, of course. And you can perfectly calculate what they pay in taxes and what they are entitled to in benefits. And then we can work out this nice measure of inequality, the Gini coefficient, from that. But that's just taking everyone in the population as they are today. People change quite a lot over time. And that's what this table sets out to show. So we can think of a number of circumstances that are maybe kind of related to poverty. So whether you're in a couple, whether you're employed, disabled, whether you have kids, all these things kind of are circumstances that we might be interested in when looking at poverty or inequality. And you can see that on average in a point in time, about 2/3 of the population are in a couple, just over half married, about 28% or so have a dependent child under 18, disabled around 8%, people report being disabled on average. This is over a few years, just averaged over on average at a point in time during kind of say the 90s, this is what kind of the population looked like. Unemployment at around 5% of the population out of work. But that's just the snapshot. If we were to instead take to repeat this survey every year, but to the same people, so we have a panel of people, send them the same questionnaire every year for 18 years, and that's the British Household Panel Survey study that did that. We can ask, were you ever in one of the times that you filled out the survey in a couple, married, had a child? And you can see these things look really different, right? So 90% of people almost are in a couple at some stage. We observed them over those 18 waves. I think the really interesting ones are here, the disability and employment. So, about a quarter of the population report at some stage over 18 waves that they have a disability. Unemployment about the same, right? So, we're used to kind of thinking about the unemployed almost as this group. But there's actually quite a lot of fluidity there. People move in and out of work all the time. And so there's not really a group of unemployed. And likewise, disabled. People people age. And it's precisely because of things like life cycle patterns in health that we observe this type of stuff, right? So there are distinct age profiles in lots of key economic variables. This shows it for labour market activity and unemployment. You can see that, the green line here is for men and the yellowish type of line is for women. And we can see that, they have really sharp age profiles. So this is age 20 to 70 on the axis there. Likewise, unemployment initially quite high for young people and then falls quite sharply. And participation drops off as people move into retirement at the end. And as a result of this, if you're kind of to take account of the fact that people experience these changes over their lives, and particularly when those age patterns also exist in things like earnings. So this just shows for, again, men and women what their earnings look like on average over age. It's a real clear hump shape. You're going to have, like, on average, people who are age 20s, in their, say, 26, they're going to have quite low earnings on average. But, they're all going to be 40 at some stage, well, those that survive to the end. And, a lot of them will have earnings that are a lot higher in later periods of life. And so we might want to incorporate that into how we think about inequality and poverty in the tax and benefit system and what it's doing. So myself and some colleagues did some work arguing that we indeed should take this lifetime perspective and try to work out what looks differently, what looks different when we do. And so the things that we looked at and things I'm going to talk about for the remaining time are, we looked at what income inequality looks like, we looked at what the tax and benefit system is doing, we also looked at a bunch of tax and benefit reforms. That's something that here at the IFS we tend to do quite a lot. We get asked quite a lot is after a fiscal event at a budget or an autumn statement, people are quite interested in what effect did this have on incomes. And so we wanted to try look at that rather than just take the usual snapshot perspective, ask what that looked like if you were to follow people throughout all their lives. And also then obviously has implications for how we should think about designing policy. However, a problem with this is data limitation. So what I showed you just a few slides ago was 18 waves, and that was just 18 repeated snapshots. So those numbers are probably underestimates for what all people born, say, in 1945 experienced, because 18 waves is only 18 years is only less than half of the average working life, right? So there's going to be a lot more mobility there that we've just missed out on. And also that was 18 kind of repeated snapshots. It wasn't have you ever at any stage during the past 18 years experienced these circumstances. It was have you ever at one of the 18 times we sent you the survey been in that circumstance. So those numbers are probably actually quite a bit higher. But that's the best panel data that we have in the UK to address those type of questions. So what myself and some colleagues did recently report was to essentially create some simulations. So we simulated what the lifetimes of the baby boom cohort, which we said that those were those born from 1945 to 54, and we simulated the lives of those individuals using data like the BHPS, which gives us how likely it is if you're rich today that you're still rich tomorrow. So we use the panel data to give us that element of things. And then there's another survey that's long running in the UK that tells us what the distribution of all these things look like over time. So, what percentage of those born in 1945 to 54 were say, earned less than £100 per week in a given year. And so we can kind of use these two data sets together to try give us some idea of what the life of those born between 45 and 54 look like. And so yeah, there's some caveats there about we assume a few things. We assume a lot more than that's there, that's in the report if you're interested. But one thing that we don't look at is the benefits of public service spending when I'm going through this. And the reason for that is it's quite difficult to work out how do you value public spending. With taxes and benefits, it's fairly straightforward because there's a cash amount that you gain or lose, and it's relatively easy to compare that across people. You can look at a chart and say that the poorest are gaining more and the richest gaining least or something, and then apply your own social judgments to that. But in terms of your own preferences for redistribution, but in terms of public service spending, what's the value of the existence of the NHS? It differs across people and it differs in very complex ways. It differs according to your likelihood of being ill. It differs according to, so including public service spending is a lot less straightforward than the already complex tax and benefit side of things. So just restricting our attention to the tax and benefit side of things. And so here's the graph I showed you just a little bit earlier on. What happens to the tax and benefit system on a cross-sectional basis reduces inequality by quite a lot. It reduces it by 31%. So that's the graph I showed you earlier on. If instead we were to take these people and look at lifetime inequality, so lifetime gross inequality, the green bar here, is a lot lower. This is before tax and benefits. If we ignored all tax and benefits across individuals' lives, we see that inequality is just a lot lower, and that's because people are moving in and out of work. The poor today are not necessarily poor tomorrow. Some of them are, but quite a lot of them aren't. But the really interesting thing is that from this lifetime perspective, while inequality in levels is lower, the tax and benefit system does a lot less to reduce inequality. So we can see the fall in the Gini coefficient from gross to net income is only 15% on a lifetime basis versus 30% on a cross-section basis. And the reason for that is a lot of what the tax and benefit system is actually doing once you take into account the life cycle is transferring resources across periods of someone's life. So within intrapersonal redistribution rather than across between different people, which we call interpersonal redistribution. And on average, we estimated that was about 57% of all redistribution that's done is actually across periods of people's lives. Now that does differ a little bit by your place in the lifetime income distribution. So those who have, who are very rich from a lifetime perspective, they actually, a smaller share of redistribution that's done by them is across periods of their life, and that's because the very rich tend to have a lot more periods where they are, say, they don't have any benefit income, but they are a lot of tax revenue comes from them. So that's kind of where that pattern comes from, and then it's kind of the opposite at the bottom of the lifetime income distribution. So again, even just a fairly simple thing of what does the tax and benefit system does? What the tax and benefit system does? Well, it does a lot less to reduce inequality, because a lot more of what it's doing is to transfer resources across my life. So if I have a child in future, I'll likely get child benefit. I'm not getting child benefit today because I don't have a child. So my net tax contributions at the moment probably look higher today than they will, say, if I had a child next period, or next year or something like that, right? So that's kind of the way to think about this here. Another question that policymakers are often interested, we want to kind of ask what effect tax and benefit reforms have had on inequality. So you might have previously seen, this again sticking with our tried and tested Gini coefficient, you might have previously seen some analysis which shows how inequality has evolved over time in the UK. That's not what this is showing. What this is showing is instead, if we took a population, say the population as exists today on this day in the UK, and instead of living under the tax and benefit system as it is today, we said it lived under the tax and benefit system as it was in 1980 or 1990 or 2000 or all these years. And then we can look at what reforms to the tax and benefit system have tended to do to inequality. So that's not what actually happened to inequality, but what direction policy was pushing, if you like. And we can do this on a cross-section and lifetime basis. So cross-section basis is just saying if the population, say today, lived under the 1980 tax and benefit system. From a lifetime basis, what the thought experiment that we're going to do is to say, take the same population, take our simulated population that myself and some colleagues created, and say that well, what would have inequality look like if they lived under the 1980 tax system all their lives? What would have inequality look like if they lived under the 1990 tax system all their lives? And so we do these two kind of experiments. And so the first thing to note is that on this cross-sectional basis, the standard way we think about inequality, that tax amendment reforms have done a lot to inequality, right? We can see that at the end of the 80s, there's a big increase in inequality there. It goes up by about 4 percentage points, so about, that's really quite significant increase. And what's going on there is there's a bunch of cuts to the higher rate of income tax, and there's also some benefit reforms. You see that nothing really happens over the 90s under the governments of John Major. There's a bit of an uptick than here. This is about 1999. And what's then we see this kind of sustained decline in inequality. And what's going on there is the then Labour government introduced a series of reforms to benefits, which made them more generous for both out of work and in work individuals. And so what we can see is that this had the effect of reducing inequality. Now, maybe a good way of illustrating what I was saying about this isn't how inequality has evolved over time is if you were to look at a graph of what inequality looked like over time, it stayed flat under Labour. But what this shows is that policy measures enacted by that Labour government acted to reduce inequality. So think of it as running to stand still. Inequality would have otherwise gone up had Labour not implemented the measures that they did. Is kind of what this graph tells you. Then there's also a uptick at the end. That's at the time we wrote this report. The new government were planning on introducing a bunch of benefit reforms in this April 2016. They're no longer going ahead in 2016. They will in the long term, but so ignore that data point there. That's just I haven't updated the graph. So that's on a snapshot basis. Things look quite dramatic. On a lifetime basis, it's a lot less pronounced. Everything is more muted. So one, we see that the level of inequality is just lower, and that's because, as we said before, people, the rich people today aren't necessarily rich tomorrow. Poor people today aren't necessarily poor tomorrow. A lot of them are, but not everyone. And so just inequality is lower in levels. But also all these changes, right? This big increase here is just not as pronounced on a lifetime basis. And that's because, for example, more people gain from the cuts to the higher rate of income tax at some stage over their life than do just today. That's not to say that a lot of people gain from that everyone gains from the higher rate cuts to the higher rate of income tax, but more do than do today. And so that's just kind of to give you an idea of how thinking about a lifetime, thinking in a lifetime perspective, does change the picture of how we evaluate tax and benefit reforms or how we evaluate inequality quite a bit. That's inequality, and that's kind of the Gini is a summary measure of inequality, which, as we said, goes between 0 and 1. But in the policy world, you might be particularly interested in distributional consequences at certain points of distribution. Maybe we care a lot more about people in the poorest income decile, and that's not necessarily going to be captured that well in the Gini coefficient. So a lot of analysis that we've done at the IFS is when there's a tax or a benefit reform, showing what the distributional impact of that reform is. And we do that by, again, lining up the population from left to right, poorest to richest, accounting for family size. And we can then say, well, the changes that were implemented, what does that imply in terms of a change in net, that is after tax and benefit income? And we can draw that across the distribution, so from the poorest again to the richest. And what we can see is, what this shows is that for a 4-year benefit freeze, which was announced in the July 2015 budget by the new government, usually benefits go up in line with a price index, the CPI. But for the next 4 years, they're going to stay fixed in nominal terms, which is equivalent to a cut because rising prices. And so what we then say, what the effect of that was regressive, right? This is what we call a regressive pattern. It's the losses are largest in the poorest decile and smallest at the richest. And the reason for that is quite straightforward, right? There's very few people in the richest decile who are entitled to means-tested benefits, because exactly at that point they're means tested. These people are just too well off to be entitled to benefits, so aren't affected by any cuts to those benefits. In a snapshot, and a lifetime, things look a little different. This is the lifetime. The lifetime series there shown in yellow. And what we can see is, again, the pattern's still very much regressive, but it is significantly less so. The losses in the bottom, in the poorest lifetime decile. So this is individuals, the tenth of individuals who have least from a lifetime perspective. They lose by less on average than kind of the snapshot poorest. And again, the reason for this is the people who are poor today aren't necessarily poor tomorrow. I'm at risk, I think, of massively overflogging that horse, but it is quite a simple point, but that gets missed maybe in a lot of policy debates. So again, measures very much still regressive, but significantly less so. Another way maybe, you might have been, say, policymaker told to what's the consequence of this reform that the government is thinking about. You might be told to assess that, and that's your answer, and change it like that. But you might also be told as a policymaker, what's the most cost-effective way of reducing inequality. There's just a magic pot of money available. We won't think about necessarily where taxes are increased or spending cut or other spending reduced to pay for it. Just think of there being a pot of money available. In this case, it's about 1% of household net income. And we were to say, well, let's just take the tax and benefit system as is, except increase some benefit or cut some tax proportionally. So just essentially messing around with the rates. Don't ignore the structure of the system, just change the rates. And what this graph says is if your goal is to reduce inequality and you have this magic pot of money available, increasing working tax credit is the most effective way of reducing that Gini coefficient. It reduces it by about 4%. It's quite similar reduction to increasing the main out-of-work benefits. I've shortened it to just say income support there, and council tax benefit and child tax credit. All of these are quite cost-effective ways. If that is your goal to reduce inequality, those are the instruments which are the most cost-effective way to do it. All the rest of the benefits shown here, they do something to reduce it, and that's still a 2 percentage point reduction in inequality by increasing child benefit. But far more people are entitled to child benefit than are child tax credit. Child tax credit is only available to the lowest income families with children, but child benefit until recently was a universal payment. On the other hand, if you were to use that magic pot of money to cut taxes, you'd actually increase inequality. And the simple reason for that is that those who are well off enough to be paying tax and therefore benefit from a tax cut, they're quite well off. And you're going to increase inequality by cutting taxes in general. And again, this is on a cross-sectional snapshot perspective. On a lifetime perspective, things actually don't look that much different. There's a bit of reordering, but what is noticeable is that, again, we have this kind of level drop, right? Just things are less effective at reducing inequality because the tax and benefit system doesn't do that well. The tax and benefit system that we have, based on annual income or current circumstances, doesn't do that well to target the kind of the lifetime poor. And so the interesting thing here is just there's a slight reordering. So essentially working tax credit and child tax credit, the main in-work, they're mostly in-work benefits. Child tax credit is available to those out of work with children. But these can be thought of as kind of the UK's main system of in-work benefits increasing those would be a very cost-effective way or the most cost-effective way of reducing lifetime inequality. So again, that's inequality. We might also be interested in. We might favour. And then the other benefits doesn't look that different. We've got again the pattern's a little bit lower. Everything's a bit more muted, and that's kind of something that we see repeatedly in this when we're taking a lifetime perspective. So you might favour increasing WTC, working tax credit, or child tax credit if your objective was to reduce inequality. But again, say if you're a policymaker who has specific distributional, or a politician who has specific distributional preferences, you say you particularly care about the poorest 2 deciles, the poorest 20% of the population. And you again have a magic pot of money available, this is the thought experiment, and you wanted to work out, well, what's the best thing I can do to transfer resources towards that group? What we consider in this graph is an equally costed increase to out-of-work benefits, in-work benefits, so that's child tax credit and working tax credit, and an increase in the personal allowance. The personal allowance is the bit of income that you can get before income tax starts to be charged. So above the personal allowance, income tax is charged. So by increasing the personal allowance, it's a tax cut. So you have your magic pot of money, and you want to decide how to allocate this based on whatever preferences you have for redistribution. On a snapshot basis, increasing out-of-work benefits is going to be the most is going to help the snapshot poor most. And again, that's quite straightforward, right? I mean, if you have no private income, you are going to be near the bottom of the income distribution. And so therefore you're going to be more likely to be entitled to means tested benefits, and so therefore more likely to gain from any increase to means tested benefits. Increasing in-work benefits is quite progressive, but I mean you've got this pattern here, and the reason for that is because, again, these are for the most part contingent on being in work, and so therefore you have some private income, and so therefore you're slightly higher up the income distribution. Increasing the personal allowance, that tax cut, the gain's mostly going to the upper half of the income distribution, and that's because you have to be paying income tax in the first place to gain from an increase to the personal allowance, and so therefore it's just not ever going to be that progressive. And then again, this is from our snapshot perspective, so this is kind of what we kind of knew already, if you like, and yeah, equally costed measures there. Now, what I find quite interesting is that from a lifetime perspective, things actually change around quite a bit for two of them. So again, we have out of work benefits are very progressive, but if you just again look in terms of the level. So this is a little less than, at the lowest decile, about a 0.9% increase in average net income, whereas back here we had a 5% increase in net income for the poorest snapshot versus poorest lifetime here, and so again it is progressive. But look, even some of the richest, even some of those at the top of the lifetime income distribution gain from this increased out of work benefits, and the reason for that is because there's some periods in these people's lives that they'll be out of work temporarily or the like. So even though that they are the ones with the most resources in terms of lifetime resources, they will in some periods be out of work and so entitled to these means tested benefits. In-work benefits, however, are, if anything, slightly more progressive in a lifetime setting. And the reason for this is because we think those in the poorest, kind of say, 3 deciles of the income distribution tend to be in sustained periods of low pay. So whereas you have some people who are kind of out of work this period, in work next period, in a kind of a decent enough job, then out of work, think maybe for blocks of like maybe 2 years. So 2 years out of work, 10 years in work, 2 years out of work, something like that. That's not really the case there's a large chunk of the population who are in sustained periods of low pay, and so therefore entitled to these in-work tax benefits. So these people in sustained low pay, they're really the lifetime poor, right? There's a big chunk of these that are lifetime poor, people who just are in very low paying jobs continually, almost continually. And as a result, actually increasing in-work benefits, these in-work benefits, is a lot more redistributive. There's also an element of the kind of the family composition going on here, but it's quite an interesting finding that, and it's particularly relevant for policymakers thinking of, if my goal is redistribution, how do I want to do it? Actually, it looks like increasing in-work benefits might be preferable to out-of-work benefits, because in addition to actually targeting those who are poor from a lifetime sense, it also doesn't have the same effect on work incentives. By necessity, increasing out-of-work benefits is going to blunten the incentive to be in paid work somewhat. How much it actually reduces unemployment in that's a really difficult question and is a complex calculation. But just the direction of the policy is clear, right? If you increase the amount of money you can get by being out of work, then it does blunt the incentive somewhat. How much, it's unclear, but it does somewhat. So if you're a policymaker, your objective is to redistribute resources to lifetime poor, this in-work benefits look like they do as good a job on average as do out-of-work benefits, but they don't have those negative effect on work incentives. And again, personal allowance, it's not really much going, it's still slightly regressive. It's, still the people who gain most from increases to personal allowance are those who are for sustained periods of time earning enough to pay tax, and they tend to be people that higher up the income distribution. It's a little less so than earlier. Remember last time it was like that, but now it's up a bit, but it's not really much different. So I think this is my favourite graph in terms of why it's important to take a lifetime perspective, because I think it can change how you think about what you want, what policy lever you want to pull, conditional on your preferences. So we've talked quite a lot about reducing inequality and alleviating, say, poverty, but there's also the flip side of that, how might you pay for that? And there's quite a lot of focus and attention paid to the additional rate of income tax, and so that's the tax rate that used to be 50%, is now 45%, and applied to incomes above £150,000 per year. There's also a higher rate of income tax, which starts a lot lower, starts at around £35,000 or so pounds a year, in that range. It's varied quite a lot over the last few years, but And that's 40%. That's the 40% tax rate. So, the high rate of tax hasn't been increased since I think something like 1973 or something like that. It's just not touched because if you ever read the Daily Mail after a fiscal event, their front page is inevitably X million new higher rate taxpayers from as a result of policy measures. So it's something that for some reason it feels politically undoable to adjust the high rate of tax. But it's a very good instrument if you want to target the lifetime rich. You don't necessarily have to reach for this 50p rate of tax. The high rate of tax on a cross-sectional basis takes most of its revenue from the richest 10% of households in the UK. And it does that quite effectively as well. It's a very progressive tax from a lifetime sense as well. So a reason why you as a policymaker might be interested in this is that the higher rate of tax, those individuals are subject to that are going to be less responsive than those subject to the 50p rate. There is legitimately some concern about, these people are more likely to be able to shift the form that their income is held away from that which is subject to income tax and take it in, say, dividends instead or something like that. And we saw a lot of that debate. So there's some concern about essentially how high you can push that additional rate. But if you wanted to raise revenues from the better off in society, there's quite a good policy instrument that's there already on both a snapshot and a lifetime perspective. So there are kind of some specific examples of kind of the implications taking this lifetime view has for design of policy. There's also maybe a few kind of slightly broader points. So one is on policymakers being clear about their objectives. So, but by this I mean, it's not always clear when you talk to policymakers or when politicians are setting out their priorities whether what they're trying to achieve, whether they're trying to essentially alleviate short-run hardship or to redistribute lifetime resources towards those who have least, or whatever preferences they have. It's not often clear whether they're thinking about it as we want to make sure no one suffers material hardship just today, or whether we want to actually redistribute resources to those who have least from a lifetime perspective. And that the answer to that question, what you're trying to do, changes what the appropriate policy instrument might be. And as we've seen through, I think, some of the examples I showed you, sometimes quite significantly, what you want to do, what instrument you want, what lever you want to pull, depends on what your objective is. And it's not always clear what people's objectives are at the moment. Second, there's often this distinction made about working and non-working families in just policy debates today, about kind of sometimes working families being seen as a group that might be more deserving of protection than non-working, or other way around, whichever point of view seem to differ. But the kind of the very concept of working and non-working families doesn't really make sense when you think about, families don't just exist today, or individuals don't just exist today. They have this full lifetime that we should take into account. And there's very, very few who are perpetually unemployed. If there's a household, if we can follow a household over time and we see that an individual is never working there, it's most likely because the one individual in that household is disabled, or the other person is caring for them, or something like that. So this kind of working, non-working families, it's not a particularly helpful distinction, and it doesn't necessarily lead to particularly clear policy conclusions. Thirdly, we've talked quite a lot about what policymakers looking to reduce inequality or transfer resources towards certain groups might favour doing, and what instruments are there, and why that looks different. And that kind of loops back into one of these things look different whether you just look today or whether you look over individuals' lifetimes as a whole. And the fourth point, again, and maybe this is the slightly wider one, is that the potential exists to do what the current tax and benefit system does more efficiently. And the reason for that is quite straightforward. It's, I showed you quite a lot of what the system does is just transfer resources from me age 20 whatever to me age 50 or me age 40. A lot of it is just within person redistribution. And to do that, what the tax and benefit system does is impose economic distortions on individuals' decisions. Taxes and benefits are going to distort the choices that I make today. Distorts in just the economic sense. It affects the decisions I make. These things are they shape my decisions. And they can do so in a way that maybe reduces the total amount of output that's created in society or in the economy. So given that that's what the tax and benefit system seems to do, quite a lot of it is just transferring resources within individuals, there might be more efficient ways of doing this. We might be able to design a kind of a more contributory system where that explicitly links the the taxes that I pay today to the benefits I get tomorrow. In the UK, it's really kind of drifted away from that over the last 50, 60 years. In places like, say, Denmark, I think it's something like, if you go out of work, your unemployment benefit is initially something like 90% of earnings up to a limit. And there's a lot more of a contributory link in a lot of continental European countries than there is in the UK. So in the UK, there's if you're in work for years and then you go out of work, you're entitled to contributory job seekers allowance for up to 6 months, and that's slightly more generous than means tested. But after then, everything's means tested. So the UK really doesn't have that. There's not a really clear contributory link in the UK system, and perhaps that's something that policymakers might want to think about, given once they take a lifetime perspective, once they kind of take into account that a lot of what the system is doing isn't redistribution across people, but redistribution within people. And then there might be a better way to design that system. We don't have any answers for what that system should look like, and it completely depends on your preferences for redistribution, your preference, all these different things. But it is maybe a debate that's kind of glossed over in policy circles today, or not had at all. So that's all I really kind of wanted to say. That just gives you kind of a flavour of some of the work that we've done recently here at IFS. And if you're interested, there's a report on the website. I think it's, what's it called? I think these slides will be up at some stage, and there's the name of the report at least is on there, so you'll be able to find it. But Jack is going to do the last lecture of the day, but he's said he might be running a few minutes because we had to move stuff around. He might be a few minutes late, but so there's a good few minutes for questions, and then I think you have a break, isn't that right? Is there a break? Yeah. And so that break you can probably take till 15:15. I have no idea what time it is at all. Then 10 to. So yeah, I suppose we have a few minutes for questions if anyone has any, and thanks very much for your attention. Yeah.
The working tax credits, or whatever they're called, they cost about 30 million quid. It seems quite a lot. I mean, okay, I take your point about them being very good at redistribution, but it seems a very high price, and I do wonder whether there isn't a better way of achieving a similar goal.
Well, I suppose it depends what your goal is. I mean, they were really established because you had kind of stagnant wage growth towards the lower end of the earnings distribution, and the then Labour government wanted to transfer resources towards that group. They're a more effective way of transferring resources. Sorry, they're a more efficient way of transferring resources towards the poor from a lifetime perspective, as I showed, because they don't have that that damaging effect on work incentives. But I mean, ultimately, it depends on your preferences, and again, probably overflogged that horse. But really, this was just to give you kind of a taste of, conditional on what you want to achieve, there might be a better way to achieve it. Oh, sorry. Say again.
Would it not be almost cheaper just to have a sort of basic income for everyone, or for people out of work and it just seems ridiculous that amount of money, people who are in work, and why aren't their wages higher? I don't understand how the taxpayer needs to pay that much for people who actually.
So yeah, there's a question about the incidence of tax credits, and that's actually something there's not that much literature, there's not that much research on. There's I think one paper by someone in LSE, and they suggest that kind of actually about 80% of 80% of tax credits goes towards those individuals, whereas maybe a fifth or so comes from reduced wages. So there's not that much evidence on it though. Economists think wages are ultimately determined by productivity, and if it's just the case that people with lower earnings that their productivity is lower because of machines being able to take over those kind of more routine tasks, eat more easily today, then you're faced with a fairly tricky problem, which is do you just not top up these wages? Do you let these people's incomes sink a lot lower, and then that has big impact on poverty and inequality, or do you try to compensate these people for some of the kind of the technological developments in the world? And they're tricky questions, but yeah, I mean they're not ones that I think anyone here claims to have the answer to. Definitely ones we're looking at, but not ones we kind of aspects to. But yeah. Sorry, I'll go here first. Then.
Is lifetime analysis something that's new in economics because of data availability now? And is there like a comparative study between, say, the UK citizens and the US citizens?
It's something that I think that essentially the Scandinavian countries have been doing for a bit longer because they have better data than everyone, and everyone's very jealous of them. So they have these ridiculous register data that have the population from 1970 with their income, their wealth, and everything about them, and just follow them through time perfectly. So they have these ridiculously good data sets. So there was a lot of work, I think, back in the 80s done by some Scandinavian or maybe Nordic, I don't exclude the Finns, economists looking at this. But then in the UK and the US, there's less being done just because of data problems. So even what we did was, it was an attempt to essentially get around some of the data problems that are there, that there isn't that long-running panel data. And it's particularly hard with panel data because people drop out of the sample, and so you end up not having a full record for them, and they're very expensive studies to do. The UK are getting better at them now. So the BHPS was the big UK one that lasted for 18 years, from about 1991 to 2008 or so. That's been replaced now by the Understanding Society, which is bigger, and so more resources are going towards them. I think there's more attention being paid to them, but one thing that is kind of maybe coming along is that governments are being better about allowing people access to their data, their tax record data and stuff and their benefit data, and so there's potentially a lot more that can be done there. But it's certainly not something that economists have ignored. Theoretically, people have always argued in favour of taking a lifetime perspective, or the advantage of taking a lifetime perspective. There are some costs, but I think it really is data that's kind of hampered that. So maybe I should just say something in terms of the cost. So it might be that one of the reasons economists say you might want to look at a lifetime income is because people can transfer resources across their lives. They can borrow and save, and ultimately, if people could borrow and save perfectly, if there's no credit market functions, then you wouldn't necessarily care that much about. You would just care about lifetime income. You wouldn't care about current circumstances at all today. You just care about transferring resources to or from the lifetime poor and rich, depending on what those preferences for redistribution are. But if there are credit constraints, maybe you do care about putting kind of if people who can't get access to loans, can't borrow against future income, then you might care more about short-run circumstances. But I think there's a good argument that you do want to have at your core the idea of long-run resources and lifetime resources, because ultimately that kind of seems as a more clear relation to economic welfare than just looking at a snapshot. But that's not to say don't look at people's circumstances today. There's a balance there somewhere. There's another question there. No, there.
Do you think that how the public perceives certain benefit changes affects how the government puts them into place? Would they go for a different system if the public would get on in it a little better? Some of them quite controversial.
I think wherever the Institute for Political Studies is, I think that might be a question for them. I mean, I don't know. As you might have guessed from my accent, I'm Irish, so I find sometimes the UK media and political debate bizarre, and I don't really understand it. So I'm probably the worst person in the world to ask, would the government be able to do something different if I think that's much more of a kind of a really interesting question, but it's not one that I know I think I can say anything about. It would definitely be stupider than anything anyone here has to say. So. Anyone else, or is that? Oh. Okay, cool. So break for about kind of 10:50. Yeah, say quarter past 3, and Jack should be down. We'll make sure someone's here at 3:15 anyway. He might run a few minutes late, but he should be here by 15:15. That's great. Thanks very much for coming along today.